Hi everybody, it's been a while since I've done one of these videos, so today we will be taking a detailed look at Reysaş and what's been going on with the company. As always, nothing in this video is investment advice. This video is produced only for entertainment and educational purposes. Please do your own research. Okay, so this is my latest portfolio update. As you can see, Reysaş is currently 88.7% of my portfolio. I have owned Reysaş for 5 years and have covered it publicly for 4 years. I have moved between the two tickers at different times, and those have been very beneficial, so my total return is actually larger than either tickers during that time. But my entire Reysaş position is currently in Reysaş Logistics, because that is where I believe the better deal is today. That is obviously an enormous position. But this is not about next week or next month. The important question is why I still own so much of a company that is no longer obviously cheap. I want to show you the defense, the offense, the compounding engine, and what could prove me wrong. As a reminder, Logistics owns 62% of the REIT, and both companies currently have 2 billion shares outstanding. At the July 31st close, REIT was trading at 38.3 liras per share, giving it a market capitalization of 76.6 billion liras. Logistics was trading at 22.2 liras per share, giving Logistics a market capitalization of 44.4 billion liras. At those prices, Logistics' 62% stake in the REIT was worth approximately 47.5 billion liras, or 23.75 liras per share. In other words, the listed REIT stake alone was worth about 3.1 billion liras more than the entire market capitalization of the parent, a gap of roughly 7%. This is a gross look-through comparison, before the parent debt, taxes, holding company costs, and other liabilities. The quoted REIT stake exceeds the parent's market cap before accounting for the parent's other assets and liabilities. That gross gap is why I currently prefer Logistics. But it is not the same thing as saying the operating business is free. My Patreon archive now contains 47 Reysaş posts. I will give you the core investment case in this video, and later I will show you where the full project-by-project work lives. Okay, now we need to separate two very different ideas: a cheap stock and a compounding business. When Mohnish Pabrai first invested in Reysaş in 2019, the company was famously available for something like 2 cents on the dollar. That is not the situation today. There are Turkish companies trading at far lower multiples and at larger apparent discounts. Cheapness is no longer the center of my thesis, despite the fact that, in my opinion, both tickers still remain cheap. The investment case has evolved from a deep value asset bargain into a long-term compounding story. I own Reysaş because I believe every dollar retained inside the company can become worth materially more over time. This chart compares 2016 with the latest 12-month figures in dollar terms. Revenue increased from about $126 million to $338 million, an annual growth rate of roughly 11%. Operating profit increased from about $20 million to $116 million, or roughly 21% per year. Cash flow from operations increased from approximately $22 million to $133 million, also a little above 21% per year. Net profit is noisy because of inflation accounting, property revaluations, tax effects, and consolidation. So I focus more on the operating profit and cash generation. The long-term direction is clear. Reysaş is much larger and much more cash generative than it was 9 years ago. The same pattern is visible in the REIT. Using the methodology in this chart, the property value increased about 5.7 times in dollar terms between 2016 and 2025. Annual rent increased about 3.6 times, and net financial debt declined in dollar terms. Reysaş has repeatedly converted retained earnings, old land, and operating knowledge into productive assets without levering the business to the ceiling. And this brings me to dividends. If you need regular dividends, Reysaş is probably not for you. Distributions are not management's priority, and I like that, as long as retained money continues earning attractive returns. If one retained dollar becomes 50 cents of value, then I would want a dividend. But if it can become $2 or $3 over time, I want management to keep it. Retention only works when management reinvests well, and Reysaş's operating record gives me evidence that it can. The same logic applies to the proposed capital raises. We still have no update on timing or terms, and value per share matters more than simply making the company larger. But if Reysaş can put additional capital into scarce land and warehouses at attractive returns like they have done so far, I do not complain merely because more capital is being raised. And today, Reysaş is going through the largest warehouse build-out in its history. Based on my work, the visible multi-year pipeline is over 500,000 square meters. Public examples include the privatization land that Reysaş acquired for 2 billion liras, alongside other projects that are mainly in the Marmara region. The crucial point is not only how much Reysaş is building, but where it is building. Much of Reysaş's most valuable warehouses and pipeline is in the Marmara region, where a very large share, around half or more, depending on the definition, of Turkey's economic activity takes place. It contains Istanbul, major ports, dense consumer markets, and major manufacturing clusters. Reysaş owns infrastructure where tenants need to be, while competing supply in the correct location is increasingly difficult to build. This March 2026 Cushman & Wakefield table shows Istanbul prime industrial rent at $11 per square meter per month, which equals $132 per square meter per year. The 113 figure visible in the table is in the euro-denominated annual number, not the dollar number. The 5-year rent CAGR for Istanbul is slightly above 17%, and I have documented examples where Reysaş has rented above that prime benchmark. Land is the raw material. You can find a contractor, tenant, and financing, but you cannot manufacture a huge industrial plot in the correct corridor. Reysaş combines its land bank with customer relationships, construction knowledge, and financing access. That itself is the moat. The complete pipeline and individual rent examples make this much more concrete, but showing every row here will turn this into an hour-long spreadsheet video. My Patreon Reysaş collection has 47 posts, including the ultimate Reysaş file, the complete pipeline, rent examples, and continuing thesis tracking. This is an ongoing research, not one report I published and forgot. In July alone, I published Rönesans Gayrimenkul Deep Dive on Turkey's largest mall owner at a 12% free cash flow yield and 63% net asset value discount. A Tüpraş Deep Dive, the July 8 Durmuş Doğan interview transcript, and a separate Reysaş update on July 3rd. The screenshot here shows the wider research library, but the most useful Patreon benefit for this video is the continuing Reysaş work, tracking each warehouse from plans to rents. If that would save you some time and help your research, my Patreon is the first link in the description and in the pinned comment. This video gives you the investment case. Patreon gives you the working files, detailed evidence, and continuing updates. Okay, back to business. At the end of 2025, independent appraisals placed the REIT's portfolio at approximately 94.2 billion liras. Reysaş GYO's regulation requires independent valuations and disclosure, making it easier to analyze compared to logistics. Appraisals are not cash, and debt and other liabilities matter as well, but the portfolio provides a substantial rent-producing asset base beneath a REIT currently valued at 76.6 billion liras. That is why I describe the REIT as the defense. The offense comes from what Reysaş can build and earn on top of that base. Warehouses are the foundation, but logistics also has other places to deploy capital. In automotive logistics, Reysaş has ordered new tractors and car transport trailers. As for the reason for these purchases, they highlighted the increased demand for the logistics business. Reysaş's main logistic business is the car transportation. It's a business-to-business model, not a business to consumers. So don't think of it like a delivery man bringing your shampoo to your door. The scale here gives Reysaş a lot of advantages. They are Turkey's largest car transporter business. The downside is that there is not enough data to calculate the return on investment for these purchases directly. The greenhouse is another option. Reysaş has about 51,500 square meters enclosed and plans another 64,000 square meters, which means more than double the total. Geothermal heating and exports could be attractive, but we need better disclosure on costs, margins, yields, and contracts. So at the end, it's an optionality, not the foundation. Energy is also becoming a more meaningful part of the group. Reysaş GYO has expanded its rooftop solar capacity from 7 megawatts in 2018 to 49 in the first quarter of 2026 and expects to exceed 50 by the end of year. The main benefit is not necessarily selling electricity for profit, but using the production to offset the power consumed across the group, reducing operating costs and limiting the impact of electricity price increases. Separately, Reysaş has bought Çağlayan HES, taking its ownership of the 6.2 megawatt hydroelectric plant to 100%. That gives the group another source of electricity production and potentially energy revenue. Now, none of this would matter if the people allocating the capital had no skin in the game. According to the latest ownership information, Durmuş and Egemen Döven directly own about 31% of logistics between them, while the two Pabrai investment vehicles own another 25.4%. Logistics owns 62% of the REIT, and Egemen Döven also directly owns 8.8% of the REIT. Now, insider ownership does not remove the governance risk, and nobody should outsource their thinking to Mohnish Pabrai. But the alignment is meaningful. The family and a long-term outside investor have substantial capital riding on the outcome. Reysaş is also unusual because management does not seem interested in constantly marketing the stock. There is no beautiful investor presentation explaining every project, segment, or returns. Durmuş Döven has said that he does not like announcements that create sudden spikes in the share price. His description was that Reysaş does not use the elevator, it takes the stairs. As a long-term investor, I like that mindset. I would rather management build warehouses compared to slides. But poor communication is not automatically a virtue. Logistics is difficult to analyze. Inflation accounting creates noise, and the group structure and financing costs are complicated. REIT valuations help us get there, but not perfectly. There are also other risks. In 2025, logistics revenue and operating profit fell, while financing expenses absorbed most of the operating profit. Turkey still has high inflation, interest rates, and currency volatility. Projects can be delayed, tenants may not arrive on time, rents can disappoint, property values can fall, and capital raise terms could be unattractive for some investors, even though I don't think any of it is likely. And finally, my 88.7% position is enormous. It reflects my own situation, research, and tolerance for volatility. I am not recommending that concentration to anyone. Concentration magnifies being right, that is correct, but it also magnifies being wrong. So, what would make me change my mind? If the new warehouses start staying empty, if returns on retained capital deteriorate, if leverage becomes reckless, if management begins funding vanity projects outside its competence, or if minority shareholders are treated unfairly, then the thesis would have to be reconsidered. A good historical record is not a permanent exemption from scrutiny. But today, I see a company with a large rent-producing asset base, a logistics platform that has compounded for years, aligned owners, scarce land, real customer demand, and the largest development pipeline in its history. Reysaş may no longer be a 2 cents on the dollar stock. That is fine. I do not need it to be like that. I would rather own a very good business at a sensible price than constantly replace one statistically cheap stock with another business that has nowhere intelligent to reinvest its cash. I have no idea what Reysaş Logistics or Reysaş GYO will do next week, next month, or even the next year in the stock market. The share price could fall while the business improves. That would be uncomfortable, but it would not automatically make the thesis wrong. I own Reysaş as a business owner. If the exchange closed tomorrow for 5 years, I would still be comfortable owning my share of the warehouses, rent contracts, logistics operations, land bank, and projects being built. If cash flows keep growing and management keeps reinvesting at attractive rates, the market will eventually have to notice. I do not know when, and I do not need to know when. That is the investment case for me. The REIT provides the defense, the operating business and pipeline provide the offense, and retained earnings provide the compounding. If you are seriously researching Reysaş, join my Patreon through the first link in the description or the pinned comment. Start with the ultimate Reysaş file and complete pipeline, then use the 47 post archive to see how the thesis developed over 4 years. You will also receive new updates and my other company research as I publish it. As always, do your own research, make your own valuation, and build a portfolio that lets you sleep well at night. Thank you for watching, and if you like the video, please do YouTube things. They help the channel a lot, and I will see you in the next one. Bye.